Welcome to The Explainer. Today, we are diving deep into one of the biggest questions in real estate. How in the world do you finance an apartment building? We're going to demystify this whole process and turn what feels like a giant maze into a clear, actionable guide.
So, how do you finance an apartment building? It really can feel like you're lost in a maze, right? But here's the thing. The secret isn't about finding some single magic key. It's actually about understanding this hidden two-part code that, believe it or not, organizes the entire market. And once you get this code, the path just opens up.
All right, here's the game plan for today. We're going to start with that foundational two-part code I mentioned. Then, we'll talk about your guide through this maze, the broker. After that, we'll break down the financing for small, mid-sized, and even large properties. And we'll wrap it all up by showing you exactly how to choose the right path for your deal.
Okay, let's get right into it. Part 1. The two-part code. Seriously, this is the language of lenders and properties. Getting this part down is the key that unlocks everything else we're going to talk about today.
So, what is this code? Well, it's actually pretty simple. The entire market is organized around this A, B, C grading system. But here's the catch. It applies to two different things at the same time: the buildings themselves and the lenders who finance them. You can think of them as two parallel tracks, and the secret is they have to match up perfectly. Okay, so on one side of this code, you've got the properties. First up, Class A. Think brand new luxury apartments in the best part of town. Then you have Class B. These are a little older, maybe 10, 20 years old, but they're well-maintained, stable, kind of like the reliable workhorse of the rental world. And finally, you have Class C. These are the older properties, 30-plus years old, that definitely need some TLC. But that's where you find that amazing value-add potential.
Now, for the other side of the code, the lenders themselves. They're also tiered, but their tiers are all about how much risk they're willing to take on. Your A-tier lenders, these are your big banks, your life insurance companies. They offer the cheapest money, but man, are their rules strict. Then you've got your B-tier lenders, who are a bit more flexible. And way over on the other end is C-tier. This is your hard money, perfect for those rehab projects, but it comes with a high cost and a short timeline.
And here it is, the big reveal, the critical link. These two systems are not just parallel, they are directly linked. A-tier lenders with their super low tolerance for risk only want to finance A-class properties. Think about it, it makes perfect sense, right? You absolutely cannot take a C-class fixer-upper to a stuffy A-tier lender. It's just not going to happen. So remember this, your property's class is the #1 most important factor that decides which lenders will even talk to you. So you've got all these A, B, and C lenders, all these different tiers. How on earth do you find the right one for your deal? Well, this is where your guide comes in. Let's talk about the mortgage broker and how they help you navigate this whole landscape. Okay, think about it this way. If you walk into your local bank, they can only offer you their products. That's it. A mortgage broker, on the other hand, has a massive network. They have relationships all over the place, with giants like Fannie Mae and Freddie Mac, with life insurance companies, with regional banks, even with those private and hard money lenders we talked about. They are your single point of access to this entire universe of capital, making sure you're not just getting a loan, but the right loan. All right, let's put this into practice. We're going to start small. When we're talking about properties with, say, 1 to 8 units, there's one loan product that pretty much rules this space. And it's a perfect example of a B-tier loan, the DSCR loan. DSCR stands for Debt Service Coverage Ratio, and the whole idea behind this loan is just beautifully simple. It's built around one powerful question. Does the property itself generate enough income to pay for its own mortgage? Lenders aren't digging through your personal tax returns here, they're underwriting the asset. The property has to stand on its own 2 feet. And the math behind it? Super straightforward. You just take the total rents you're collecting each month and divide it by the total monthly housing payment. And that payment, often called PITI, is just the principal, interest, taxes, and insurance all bundled together. So let's look at an example. If you're bringing in $2,500 in rent and your total payment is $1,550, you get a DSCR of 1.61. What does that number actually mean? It means the property is generating 61% more income than it needs to cover its own bills. That's a healthy property. Most lenders want to see a number over 1.25, but that's the basic idea. Now, even though these loans are all about the property's income, it's not a total free-for-all. Lenders still need to manage their risk, right? So they're going to have some basic guidelines. They'll definitely look at your credit score. You'll still need a decent down payment, usually around 20%, and they want to make sure you have some cash left in the bank after the deal closes, for a rainy day. Okay, So what about that middle ground? You've got a property that's too big for a simple DSCR loan, but maybe it's not quite big enough for the major institutional players. Welcome to the world of mid-sized properties, where everything revolves around one thing: relationship banking.
So the loans in this space are different. For one, they almost always require what's called a personal guarantee or full recourse. And let's be really clear about what that means. Your personal assets are on the line if things go south. And you're not usually going to find a 30-year fixed rate here. Instead, you'll see hybrid loans where the rate is fixed for, say, 5 or 7 years, and then it either adjusts or the whole loan comes due.
And even within this middle market, you've got a strategic choice to make. You could go with a big, A-tier regional bank. They offer scale, which is great if your plan is to build a huge portfolio, or you could partner with a smaller, B-tier community bank. They might not have the same scale, but what they do have is deep local knowledge and more flexibility. Maybe they'll waive a prepayment penalty because they know you and they know the neighborhood. It's a classic trade-off.
All right, now it's time to head into the big leagues. We're talking large, stabilized apartment buildings. And when you get to this level, you get access to a whole different world of capital, the most efficient, lowest cost money out there.
For these big Class A and B properties, the financing world is really dominated by three major players. You've got the agency lenders, that's Fannie Mae and Freddie Mac. You've got the super conservative life insurance companies, or LifeCos, and you have CMBS loans, where loans get bundled up and sold to bond investors. Let's zoom in on Fannie and Freddie for a second, because they are truly the workhorses of the multifamily market. At first glance, their programs look really similar, but the devil is in the details. The differences can be subtle but really important. For example, Fannie might be your go-to for a full 30-year fixed rate, but maybe Freddie is offering more aggressive leverage if your property is in a hot downtown market.
You know, one of the quickest ways to understand a lender's appetite for risk is to look at their maximum leverage, or loan-to-value. Basically, how much of the deal are they willing to fund? As you can see, the life companies are the most cautious, capping out around 65%. On the other end of the spectrum, you have the agency lenders, Fannie and Freddie, who will go up to 80%. That means you, the investor, gets put less money down.
So this really boils it all down into a strategic decision matrix. It's all about what matters most to you. If your number one priority is getting the absolute rock-bottom lowest interest rate on a stunning Class A trophy property, you go to a life company. If you need that perfect all-around blend of high leverage and great long-term rates, agency is almost always the answer. But if you need the absolute maximum leverage on a more unique or complicated asset, then CMBS is the path you're going to take.
Okay, wow. We have covered the entire map, haven't we? From small duplexes to massive institutional-grade apartment complexes. So the big question is, how do you take all this information and actually choose the right path for your deal?
Well, it really comes down to this simple three-step framework. And you have to do it in this order. First, assess your property. What is its size and what is its class? Just answering that one question will immediately eliminate a ton of options. Second, what's your business plan? Are you planning to hold this thing for long-term cash flow, or is this a quick flip? And third, what is your single most important priority? Is it the lowest rate, the highest leverage, or the most flexibility? I promise, if you answer these three questions in this order, the optimal financing strategy will become crystal clear every single time.
Because at the end of the day, securing financing isn't just a transaction. It's not just about the money. It's about building the right team. The very best lenders and brokers become strategic partners, people who are actually invested in helping you succeed and grow your portfolio. So the final question you should ask yourself isn't just where can I get a loan? It's who do I want on my team for the long haul?